from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, to court Musk goes. Twitter's lawyers say his termination of the deal was wrongful. We will talk to a former Twitter insider about where the legal saga goes from here. Plus, Peloton's uphill battle continues. The connected fitness company will now stop making bikes in-house. Shares jumping on the news. We're going to have all the details. And funding for crypto startups plummeted last quarter. We'll ask Lightspeed venture partners why they are planning to double down on the blockchain. And Sequoia's Jess Lee will join us to talk about their new plan to hunt for what they call outliers and put $1 million behind these new ideas. We will get to all of that in a moment, but first I want to get a look at the markets. Tech pulling stocks lower in the last couple hours of trading ahead of key consumer data coming out in the next 24 hours. Bloomberg's Ed Ludlow has all the moves. And Ed, here we are again, tech losing steam.
Yeah, it's interesting. I mean, more muted moves to the downside than perhaps we saw on Monday. But you're right, that key CPI data due on Wednesday, 8:30 a.m. Eastern time. And with that in mind, Em, I've got a public service announcement for you. You know I love to do that when it matters. The U.S. Bureau of Labor Statistics has put out a statement this evening saying that there is a fake June US CPI report doing the rounds online. So any eagle-eyed investors watching the show, take caution, wait for the official release of the data Wednesday, 8:30 a.m. Eastern time here in the United States. Also some breaking news after the bell as well from the IMF. In the last few minutes, the IMF has cut its global GDP growth forecast for 2022 to 2.3%. versus its prior 2.9% forecast. So you look at the markets board on my left-hand side, NASDAQ 100 down a percentage point. Pretty significant pullback in yields, although it eased off on the 10-year down to 2.97%. We're talking about recession concerns, right? And we're zeroed in on this idea that we're focused on earnings season to get some more granularity on how the global economy is looking, the strength of the global consumer. I also put Bitcoin there because we are now again below 20,000 US dollars per token. In fact, look at this Bloomberg terminal chart very quickly. Bitcoin's kind of caught up in this risk-off sentiment that we've got right now. You see that kind of right-hand side of the screen, the drop since June, traded sideways since that big drop in the month of June at the 20,000 level. Of course, this is an asset which was previously called an inflation hedge. But as central banks around the world have moved on with their policy to fight inflation, Bitcoin's not really been an inflation hedge, and it has kind of traded sideways in recent weeks. So it's something we're keeping a close eye on. Let's talk about the world of EVs very quick. Canoo, this is a name I haven't said out loud for a very long time, but you look at this chart on my screen, whoosh, massive jump in Canoo. Why? A deal with Walmart to build 4,500 EVs for Walmart, really changing the game. This is basically a penny stock on Tuesday morning, and look at that massive jump. And then in terms of some of the other movers that I'm keeping my eye on, it's the mega caps, because some mega caps really pulling the NASDAQ 100 lower throughout Tuesday's session. There was one name, I think Apple, one of the names pushing to the upside, but we're in wait and see mode, because these are the critical names in this earnings season starting this week in July, where we get a sense of what is going on in the world. Apple up 0.7%. The rest of the mega caps down pretty significantly.
All right, let's talk about something else that's going on in the world, and that is Twitter officially suing Elon Musk to consummate, that's the word they use, that $44 billion deal that he is trying to pull out of. Ed, Twitter suing to force him to do the deal that he promised to do, asking a Delaware judge for the case to be heard in September. We're also getting some headlines about a memo that Twitter's leadership sent to staff saying they've asked for an expedited trial. You know, as we know, we've been talking about, it's not necessarily a great atmosphere among Twitter employees given all of this uncertainty. But obviously, this is something that we were expecting, and the legal saga will continue. Yeah,
Bloomberg had reported Sunday, according to sources, that this was the action we'd get, a Delaware court filing early in the week. You know, the point that Twitter's board and management are trying to argue is that Elon Musk did not have any grounds to walk away from the deal, right? There's no such thing as buyer's remorse. Elon Musk's argument is that Twitter was not forthcoming with its data that he requested on dates that he listed in his filing on Friday about the issue of bots. And what Elon Musk is going to have to prove in court is that the way Twitter acted, the information that it either did or did not share had material adverse effect on the deal. In other words, they need to prove that it somehow altered the value of the deal, that it punched a hole in the deal. But you look at past precedent, Elon Musk is going to have a really hard time doing that. So we knew this was coming. We're up 0.8% in after hours, maybe a little relief rally because we saw this coming. But most lawyers Bloomberg have spoken to think that Twitter has a really good chance in this fight. But it could be a long fight, right? If you're Twitter, you want to go to court for a decade, 3 years, 2 years, who knows? This is Elon Musk we're talking about, the wild card man.
Indeed, and this after Twitter shares plummeted yesterday, made up some of those losses today and just a little bit more just now after hours. Okay, Ed, thank you. I want to bring in Jason Goldman now, one of the founding members of Twitter and former White House chief digital officer under President Obama, for some insider-outsider perspective. Jason, your timing is impeccable. Look, officially this is headed to Delaware court. Does anybody win in this scenario, no matter what happens?
Definitely the lawyers win. The lawyers are excited when they describe a case as being unprecedented and complicated. That's definitely code for there's going to be unprecedented legal fees. So they're set. Everyone else is a loser in this for sure. Elon has shown he can't be trusted to execute a signed deal. The board has shown that they have no confidence in the long-term future of the company and are now going to Delaware to consummate a transaction with a bad faith actor. And the employees are left in limbo wondering what the future of the company will hold.
So, look, last week when this happened, Brett Taylor, the chairman of Twitter boards, said that, they're committed to closing the transaction. They plan to pursue legal action. Now here we are seeing them pursue this legal action. Then you had Ev Williams getting into the fray. And obviously, I know you and Ev worked very closely together in those early days, responding to Brett saying, I'm sure there are legal and fiduciary reasons you have to say that. But if I was still on the board, I'd be asking if we can just let this whole ugly episode blow over. Hopefully that's the plan, and this is ceremony. What do you think the plan actually is? And is this ceremony?
No, I mean, at this point, the board has to sue and try to get the agreement agreed to enforced. Like they have no choice as fiduciaries to do anything but that. I think what Ev is expressing what I agree as well, is that I wish the board had more insight at the beginning of this to realize that they were dealing with someone who just wasn't serious and didn't have a real plan for what to do with the company. And instead, led by Jack, they kind of became besotted with this idea of Elon owning the company. The first step of avoiding a trap is knowing that it's there. And the board just simply didn't realize that they were walking into one and striking a deal with Elon in the first place.
So why do you think Elon actually did this in the first place? There was one venture capitalist who pointed to the idea that he just wanted to sell some Tesla stock. What do you think the real motivation was?
I think he enjoys using Twitter and is addicted to the service and thought for a while it would be fun to own it. I also think if you look at the proxy filing statement that Twitter filed on the deal, that they had a signed agreement to just get Elon on the board and have a standstill agreement where you would own no more than 15% of the company. And then he had a conversation with Jack on the same day that agreement was announced, and it quickly pivoted to, I should just own the company as a whole. I think that's one of the reasons why this deal is also likely to settle, is that there's probably a lot of conversations between Elon and the company in the agreement phase that they don't want to come out in discovery. And so this is something that ultimately I don't think will be decided by the courts, but will be decided in a settlement between lawyers.
Okay, but I wonder how this plays out. If Elon Musk still ends up having to hold up his end of the deal and Twitter, quote unquote, wins, is that good for anyone?
No, it's not good for anyone. It's not good for Twitter if Elon ends up owning the company, because he doesn't have a real plan for what he wants to do with it. He's revealed that over time. It's also worth noting that there were any number of Silicon Valley luminaries that lined up behind Elon owning the company and pledged to be equity partners. Whether that's Andreessen Horowitz or Sequoia or DFJ or free speech advocate, the Qatar Sovereign Wealth Fund, all of those folks have gone remarkably silent in terms of their belief in Elon as the ultimate owner of this company, because in his conversations, he showed he wasn't serious about what he would do with it. So Elon owning it isn't good. A settlement is unlikely to equal any amount of value that equals the damage done. And the real problem is that there's actual employees who want to make a better product and want to make the company better for the future, but they just don't have the leadership that will enable them to do that.
Let's be clear. I mean, there are so many users, including Elon Musk, who love Twitter, love using Twitter. But, Twitter over so many years just hasn't been able to parlay that into a significantly bigger business. What would your plan be to increase engagement, to drive more revenue, to increase the number of users?
Well, let's be clear. I'm not here auditioning for any job at Twitter. I think what the board needs to do at the end of this juncture is find new leadership. That's not a job I'm auditioning for. What I think they need to do is look at users that have found tremendous value from it and build engagement around it. I don't think that the company is one silver bullet away or one feature away from fixing the trajectory that it's on. But it's obviously something that's always had cultural value and cultural resonance. And it's something that I think continues to play a role in global politics and the global conversation. One point on that is we've spent months arguing what Elon has meant about free speech online, and he's slowly evolved that viewpoint from just mean anything to comply with legal requirements of local regimes. In the meantime, while we've been debating, trying to tease out any meaning from what Elon's position on free speech is, Twitter is actually in court in India trying to push back on an authoritarian creep into free speech laws in that country. And so there's actual real stakes at play here, and the company is fighting good fights around the world. It's just that they're having to do so now under this cloud of Elon's acquisition.
Real stakes indeed. Jason Goldman, one of the founding members of Twitter, former White House Chief Digital Officer. Jason, as always, thank you for your insights. Meantime, bargain hunters might be a little underwhelmed by Amazon's two-day Prime Day sale. The annual event began today, but many sellers are minimizing their discounts to cover their own soaring costs. Prime Day helps Amazon lock in shoppers before the holidays and deepen its relationships with existing customers with deals on Amazon gadgets like Echo. Coming up, Peloton is going to stop making bikes in-house, marking one of the most dramatic steps yet to simplify its operations and cut costs. All the details next. This is Bloomberg. Now, Peloton making a major strategic shift to cut costs and streamline its strategy. The company will stop building exercise bikes and treadmills at its own factories, a big bet of the former leadership team. Peloton making this change after several months of turmoil. Shares of the company are down 75% so far this year. Bloomberg's Mark Gurman, who of course covers Peloton, with us now for more. So talk to us about the significance of a pretty dramatic shift here, Mark.
This is an end-to-end overhaul of their operation. So just to set the scene, let's look at Apple for a second. So Apple obviously designs the iPhone and their other products. But what most people don't know is that they have a third party called Foxconn that manufactures it, right? So Apple works hand in hand with Foxconn to actually build those devices. They don't do it in-house. Peloton, however, did both. They built a big portion of their bikes in-house using their own facilities and also contracted out another portion of their devices to different technology manufacturers in Asia, one called Rexon, one called Quanta, one called Pegatron. So what Peloton is now going to do is they're seizing their in-house production operations and they're moving entirely to contract manufacturers. That's going to simplify their entire business model because instead of having two distinct supply chains, they're now going to have one supply chain. They're also unfortunately laying off about 570 workers at their in-house facilities, and they also believe this is going to up product quality, as there's been some issues there, because all of the in-house quality control is going to be in one place. You're not going to be split between two different production development styles.
So will this solve Peloton's problems? That's the question.
Well, Peloton has many, many problems. This will solve one of them, I think, right? One of their problems was the ability to gauge supply and demand and tie that to production, right? So as we know, Peloton's downfall really happened after they overestimated that demand would continue to occur even as the pandemic slowed down. That left them with an overabundance of inventory and nearly cratered the company into the ground. We see what's happened to their stock price. If they had had only contract manufacturers, that probably would have been easier to resolve because now they're not owning all that inventory in-house. They're working with a third party and it will give them better supply and demand balance and allow them to better optimize their supply chain. But Peloton's problems go far beyond their supply chain. There's issues with pricing. There's issues with how much their subscription costs. There's issues of people not wanting to even just buy their equipment, right? There is competition. Obviously, Apple Fitness Plus. There's Nordic Track. There's so many other companies. There's Tonal. There's the question if they're even hitting the market with the correct products. Their product development is taking a long time. They've been developing this rowing machine now for almost 3 or 4 years. The Peloton Guide, their new TV connected device, that has not gone off to a hot start. So to answer your question, this solves one of their problems, but there's many more to go. It's sort of like whack-a-mole.
All right, Bloomberg's Mark Gurman, thank you for sharing your insights there with us. Whack-a-mole indeed. Okay. Shares of Canoe soaring, at one point doubling in value in Tuesday's session. This after the struggling electric vehicle startup won an order for 4,500 vans from Walmart. Canoe recently moved its headquarters to Walmart's hometown of Bentonville, Arkansas. In May, the company warned that there was substantial doubt about its long-term future, but now at least some investors seem a little more optimistic. Coming up, there's been a major slowdown in crypto funding this year. We're going to chat about that with one venture capitalist doubling down with a new team focused solely on investing in the blockchain. A story we continue to watch, delivery company GoPuff is cutting 10% of its workforce and closing dozens of warehouses. This in an effort to conserve cash as the economy slows down. The job cuts will affect about 1,500 people in corporate and warehouse jobs in the United States. GoPuff will shut 76 warehouses, or about 12% of its network. Meantime, Lightspeed venture partners just raised $7 billion for an early and growth stage entrepreneurs. The firm also just announced Lightspeed Faction, a new team fully dedicated to blockchain investments. Venture capitalists have cooled on crypto recently, with PitchBook reporting a 31% quarterly decline in crypto investments through June. Bejul Sumaya is a partner at Lightspeed Venture Partners and joins us now from New Delhi. So, obviously, you just raised $7 billion new dollars in fresh venture capital. Talk to us about the process of raising this funding, especially in a very, very difficult macro environment.
Yeah, thanks, Emily. Well, I think getting this done is really a reflection of the strength of the franchise and really the quality of founders that we've been fortunate to work with, and an LP base that's sophisticated and has seen through multiple cycles, is very committed to the asset class. And so we're really fortunate to have raised this capital at a time that I think will hopefully prove to be a really good vintage for venture and for founders that are building for the next 7 to 10 years.
So where do you plan to deploy this and how fast, given these tumultuous market conditions?
Yeah, we typically target a 3-year new investment period for our funds, Emily. And, one of the reasons for the scale of this capital base is over the last 20 years, really in 2000, Lightspeed believed that innovation and technology entrepreneurship would be a global phenomenon. And it was a little bit contrarian at that time. But as a result, the firm has built a presence. Today, we have 70 investors across 12 offices in 6 countries. And so there is a lot of opportunity globally. The scope of the sectors that we invest in has also increased now with pharma and biotech, in addition to enterprise, consumer, fintech, crypto, and a growth practice. And so I think we're seeing a lot of opportunity in these areas. Undoubtedly, the market for growth is already slow, and we think will remain that way. But we'll be patient.
So, talk to us about the global trends you're seeing. For example, how are you seeing the slowdown impact startups in India? Is it similar to what we're seeing here in the United States, or are these macro conditions playing out differently around the globe?
Yeah, it's a really interesting question. I think what we see is the macro conditions actually play out differently across sectors and differently across countries. So, for example, even within the US, consumer has seen some impact really early on. Enterprise, not just yet. Obviously, sectors like pharma and biotech will have very different dynamics. Somewhat similar with countries. In India, for example, I don't think we're going to see a recession. The country is growing at about 7.5%. But what we are seeing, and we've been used to inflation again in the high single digit figures, and the central bank is somewhat used to managing that level of inflation. But what we are seeing is an outflow of foreign investment as capital moves out of what are perceived as riskier countries and emerging markets. And that has an impact on the financing environment for startups, more so right now than the macros.
Now, obviously, crypto and the blockchain are two different things. We've seen, but they're certainly linked. And we've seen the crypto market take a nosedive. We're in the middle of a crypto winter. Nobody knows how long it's going to last. Why double down on the blockchain now?
You know, I think when you, or at least at Lightspeed, conviction is a really important word for us. And when we believe in the future of something, we don't try and time it. In the early 2000s, we believed venture capital would be global. That wasn't a widely shared view. We committed to that. And maybe for a decade, it wasn't clear that that was the right call. I think sitting here today, none of us would argue that that technology and innovation is global. I think very similar with respect to blockchain and a lot of the infrastructure that we're looking to invest in. We're not trying to time the market. I think it so happens, and we believe that actually the next few years, with a lot of the FOMO out of the market, a lot of the outsider capital out of the market, may be a really great time for committed teams to build and for long-term venture capital to invest.
Lightspeed's invested in 30-some companies that are now public companies. How long do you think this downturn lasts? When does the IPO window reopen? We have 30 seconds.
I wish we had a crystal ball. Feels like it's going to be longer than the previous downturns, given the multitude of factors at play, Emily. So, you know, we're thinking certainly well into 2023.
Interesting. All right, Bejul Samaya, thank you for joining us. I know it's a very early morning for you there in New Delhi. Appreciate you waking up. Lightspeed Venture Partners, we'll keep watching. Okay, coming up, female-led startups had a record year for funding in 2021, but 2022 looking like a different story. Can firms like Sequoia Capital continue to push diversity in tech? We're going to ask one of the partners next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. I'm going to get back to the latest on Twitter and Elon Musk. In the last hour, Twitter has sued Musk in a move to force the world's richest man to consummate his proposed $44 billion buyout of the social media platform. Our Ed Ludlow back here with the headline. So we've read some of the fine print now. What is Twitter arguing in this filing? Yeah,
they're basically saying Musk does not have a right to walk away to an agreement that had very few conditions. They're saying he agreed to $54.20 a share, $44 billion takeover, and that he can't walk away. We have this quote from the court filing we can bring up on the screen. Musk apparently believes that he, unlike every other party subject to Delaware contract law, is free to change his mind, trash the company, disrupt its operations, destroy stockholder value, and walk away. And Twitter's basically pointing out...
Fighting words.
Fighting words. And just because the stocks generally have fallen down in the sector, including social media stocks, he can't just have buyer's remorse, is their basic argument.
So does Twitter have a case? Or whose case is better, right?
Right. So most lawyers that we've spoken to at Bloomberg think that Twitter do. It comes down to material adverse effect. Musk's argument is that there wasn't enough information handed over on bots, and this is where the court case is going to be fought. Did they or did they not share enough data? Material adverse effect meaning, did them withholding data on bots or not sharing enough, or what they did share actually alter the value of the deal? And if it did, then Musk could win. But I think most lawyers would see Twitter has a good chance here.
All right, Ed, thank you.
Thank you.
Meantime, Sequoia Capital may have $1 million for your idea. The storied venture capital firm is now accepting applications for its seed stage catalyst called ARC. They say they're looking to fund outlier founders and teach them how to make their ideas a reality. Jess Lee is a partner at Sequoia Capital and joins us now to tell us more. Jess, great to have you with us. So walk us through the vision for ARC and how you think this sets apart what Sequoia is trying to do here.
Thanks for having me, Emily. ARC is Sequoia's new seed stage catalyst for outlier founders. We offer three things: $1 million investment from Sequoia, as well as 7 weeks of programming on foundational company building topics. And you're working alongside a cohort, a community of really exceptional people who are at the same stage as you. The reason we're doing this is we know it takes a lot more than just money to create a category defining company. And we know founders want company building help. And Sequoia's had the privilege of working for over 50 years with some of the best founders. What we've tried to do is take all those lessons, all those mistakes, the journey of all the other founders that we've worked with, and boil them down into foundational company building concepts, everything from product to customer obsession to culture to how to hire. And so that's the 7 weeks of jam-packed programming for ARC.
When you say outlier founders, right, applications are open now until July 22nd?
That's right.
All right, so you've got a few more days. So when you say outlier founders, what exactly do you mean? Sequoia's done a lot of really innovative things in the past, for example, your Scout program to try to find, unearth new entrepreneurs and new ideas. Why do you think you need to do this as well to find those outliers?
The venture market has been continuously evolving over the years, and I think there are a lot more founders coming into this space as investors and a lot more product thinking and innovation. What can a firm offer beyond money, which is actually a commodity, and a board member? And so we often think about, what do founders need? They're our customers. How do we work backwards from that and figure out what they need help with? And the number one request we get, and the number one thing I think Sequoia delivers, is help with actual company building. And so we really tried to boil down everything that we've learned over the years through working with some of the best into the core things that you for example, when I was a founder, there are things I wish I could have gone back in time and told my younger self about how to run a company. That is a lot of what ARC teaches.
Now, every company gets $1 million. What is Sequoia's stake, and what is the chance for follow-on funding?
It varies from company to company. Some are pre-seed 2 people with an idea. And then some are actually a little bit further along, and we put $1 million into their existing seed round that maybe they've already raised. So it's a little bit of a range, but the focus is really on how to build an enduring company, a company that lasts for decades, not just how to get to the next quarter or the next fundraising milestone. So there's a little bit of a range.
So given this very tumultuous macro environment that we now find ourselves in, how is that changing what you're looking for, what you're looking to fund at the seed stage or the early stage or the growth stage? I mean, Sequoia really runs the gamut.
Yeah, I would say that we've seen multiple compression and valuations come down. I don't think we've seen earnings compression yet. And really, I think consumers are feeling poorer, and that's going to trickle down into the way people spend and the behavior of buyers, both on the consumer side and the enterprise side. That said, Sequoia has been designed to outlast the cycles in the tech industry. The purpose of our firm is to look beyond those short-term fluctuations. And so we're looking for the same thing we were looking for before, which is founders that have a unique insight, who have a lot of grit to endure these ups and downs, as well as just the difficult journey of starting a company. And we're looking for large markets where you think you can build, almost like define a category from scratch, create a new one.
What is Sequoia's read on the macro environment right now, and how bad this will be for tech?
I don't have a crystal ball. That said, I do think that, like I said, we've just started to see multiple compression and not yet earnings compression. I really think people are.
What do you mean by that?
We basically, the public market has returned to historical valuations, the revenue multiples, but earnings have not. I don't think we've seen the full impact of consumers feeling, wow, gas is really expensive. My company had layoffs. I can't buy as much enterprise software. So I think that may still be coming. That's what we've been forecasting for our founders. We called an all hands recently where we gathered all of our founders and we walked them through what we were seeing in the market, as well as how to think about forecasting, financial planning, and how to lead in uncertain times. So that's what we expect. As for how founders should react, that really depends. It's on a case-by-case basis. Some founders are in a great cash position and should be leaning in very aggressively. What we see in these down cycles tends to be that hiring freezes, everyone sort of pauses and reflects, and it actually becomes easier to get a higher concentration of talent versus before you were competing with the FANG companies, with every single startup, seed stage, everyone was hiring. And now I think for the mission driven, for the people who are venturing out of jobs now, it's actually possible to get a greater concentration of talent. And then some folks are in a not so great cash position and may need to take more drastic action, but it's really case by case. And so we walk our founders through all of that.
Sequoia is famous for its RIP Good Times message, which you gave to entrepreneurs in 2008, the height of the financial crisis. What's the headline of the presentation today, or what would it be today?
It was called Adapting to Endure. It was about how to build those long-term enduring companies, how to outlive the cycle. The founder of Sequoia, Don Valentine, he had a license plate that said verrückt on it, which is the German word for crazy or insane. And he, some of the wisdom that gets passed down from him as well as to every throughout the partnership has been that tech moves in these cycles. There are 4 phases. The first, the one we were just in was called verrückt. It is the hype, the excess, the high multiples, like parties, when Lambo. And then there's a correction, quite sharp correction where people tend to freeze. And then, course correction, and then it slowly comes back, and then it happens all over again. That's sort of what we've been seeing play out over decades. It is compressed in certain industries like crypto. I would say the 12-year bull market becomes a 4-year bull market. But the best companies are often formed in that correction phase. It's the founders who really are mission driven. They want to start their company no matter what. They're courageous, they're brave, they have the grit to outlast it. They can get that concentration of great talent, and they have fewer competitors. So we believe at Sequoia that now is a great time to start a company, and that's why we launched ARC.
Now, last year, Sequoia made a big break with tradition to do away with traditional venture capital timelines, and in some cases keep money invested longer in companies, your portfolio companies, going public. Some of these companies have had a tough time in the public markets: Airbnb, DoorDash, Robinhood. Is that strategy evolving at all given these tumultuous chimes? And are LPs reacting at all, or asking for their money back or out sooner?
So the purpose of the Sequoia Capital Fund was actually to look beyond those short-term fluctuations. It allows us to be the long-term partner, the shareholder, the long-term partner, we don't have to immediately distribute after the IPO to lock in some return for our LPs. It also actually lets us generate superior returns for our LPs. We get to capture the compounding value. Some of the best companies, Google, Cisco, Airbnb, the companies we've had the privilege of working with for a long time, we have a lot of information about how well they're doing and the real, what those founders are truly like. And so we think we're in a better position to manage some of the distributions for our LPs. And the founders really love that we are that long-term partner. So the strategy has not changed.
Okay. Now I have to ask you, you're on the board of Allraise. You mentioned you're a founder yourself. There's been a lot of concerns about women backsliding in the pandemic. And I wonder if those concerns continue, if there's concern about women backsliding in a downturn. What are you seeing out there? Are you concerned, or, do you see, a bright future?
Yeah, this is a deeply personal issue for me. I was a female founder. I was working on a product targeted at women, and it was very hard to fundraise. I never pitched a single woman investor. And I made the connection. I realized that the complexion of who makes funding decisions affects what problems and what customers get served in the world by the tech industry. That's part of what motivated me to move to venture and to co-found Allraise alongside 30 other amazing women in venture and female founders. I think in some ways we've moved forward. Certainly the percentage of women check writers at VC firms has gone up. I think it's moved from 9% to 14% in the last 4 years. I'm very proud that at Sequoia, over 25% of our investing team is women, which is high for our industry. There are some steps forward. However, there are also some steps back overall for women in this country. I think, the overturning of Roe v. Wade is a tragic step backwards. I think a lot is going to fall on the tech industry, on innovative founders, on employers to help move the ball forward for women. I'm very proud that Sequoia is a backer of Maven Clinic. Maven is the leading women's family health telemedicine platform. It does everything from pregnancy counseling to IVF and egg freezing on the fertility side to maternity and postpartum. I've used it through pediatrics. I asked a lot of new baby questions. I just texted them to a pediatrician. It's a wonderful service. And it does offer a wallet option that allows employers to pay for travel out of state, as well as to cover things like fertility benefits. So I think a lot is going to fall on hopefully some of the tech industry, some of the female founders. And so we just need to keep moving. I'm optimistic in the long term, but it's always, multiple steps forward, a few back, and then we continue to make progress.
All right. Well, appreciate you sharing your thoughts on all of that with us. Obviously, you have a very long history in this industry. Sequoia Capital's Jess Lee. Jess, great to have you with us. All right, coming up, Bitcoin miners feeling the heat with the Texas power grid near the brink. We're going to talk about the impact of the heat wave in the Lone Star State that has become a hub for digital assets. That's next. This is Bloomberg. Now for our crypto report. Joining me now, Bloomberg Sonali Basak, in the middle of crypto winter. Sonali, of course, we've been talking about startup funding for crypto falling off. Talk to us about the where the tide is going here.
Yeah, think about the massive disconnect you're seeing here, Emily. You have billions of dollars, $10 billion in the first quarter alone raised for venture capital in the crypto space, but the funding of the startups themselves has really fallen off, and you really started to see that in the second quarter of this year, where funding dropped by 31%, according to PitchBook data. There were some venture capitalists that spoke to Bloomberg that gave more specifics on what that looks like. At the seed stage, it's not as dramatic of a drop, but as you start to get into Series A and later rounds, you could see a 50 or 70% drop in valuations, which is what is making venture capitalists so nervous here. You don't want to catch a falling knife. So until you see a little bit more stabilization in the industry in terms of where prices will go, as well as a shakeout here in terms of the types of projects that will make it through this cycle, it's going to be hard to see tons of money being put to work, though we are seeing some high-profile names still being funded. I know you and I, for example, spoke to Magic Eden, an NFT marketplace, just weeks ago. But again, these are one-off situations and not the norm in this environment.
How easy is it going to be to spend this money that these venture capital funds have raised? Andrew Zanarowitz, Katie Hahn, we were just talking to Jess Lee from Sequoia. Are they going to be able to put all the money they raised to fund crypto to work?
Yeah, it's a great question because you have to see if the definition of crypto will change by any means. Are you going to start to put money towards projects that are Solana-based, or are you going to put money towards projects that are more Web3-based? You see gaming and crypto become a very popular environment here, so you can maybe see things start to change in terms of definitions of crypto. But again, we're looking at the price of Bitcoin. Bitcoin is, of course, still king here, Emily. When do prices stabilize? Until that happens, it's hard to see massive amounts put to work.
All right, Sonali Basak, thank you for that update. Coming up, calling for computer education. We're going to speak to the CEO of Code.org, Hadi Partovi, about the company's mission to boost computer science in schools and all the CEOs that have pledged their support. He's with us next. This is Bloomberg. Over 500 of the top CEOs in the United States have joined an effort by Code.org urging governors and state education officials to ensure that all U.S. elementary and high school students have the chance to study computer science. This comes as demand for talent to fill jobs in cybersecurity, data science, computer programming has skyrocketed. Many of those jobs are unfilled. Joining us for this week's Techonomics segment, Hadi Partovi, founder of Code.org, also a longtime investor, tech entrepreneur yourself. You've been doing this now for 9 years.
9 years, yeah. It's been a
trying to
long
get
time.
computer science taught in schools. How much progress has there actually been?
When we started, 10% of US schools taught computer science. Now it's at 51%. So we've now tipped it. So if you're a parent whose your child's school doesn't teach computer science, you're now in the minority. But we still want to get to the point where 100% of schools teach computer science. And we're also at the point where even with all these schools teaching it, only 5% of high school students study computer science. And we want to reach every kid. So that's the next decade of work, is to get to every single student in every school.
So you've got Mark Zuckerberg, Sheryl Sandberg, Jeff Bezos, Sundar Pichai, and hundreds more who have signed this letter. What will this letter actually accomplish?
Well, the first thing I wanted to say is it's not surprising to see folks like Tim Cook or Bill Gates or Mark Zuckerberg saying that schools should teach computer science. What's truly unique is the companies outside of the tech sector, the leading companies in retail, transportation, finance, even in coffee or toys or Starbucks, Nike, Hasbro, these companies, Nordstrom's, UPS, Walgreens, are all getting behind computer science to show that computer science is no longer about just jobs at tech companies, because every company is becoming a tech company. Every company has data science needs or cybersecurity needs.
So have you gotten a response from lawmakers, from the people who have the capability of changing this, of adding this to a school curriculum?
We have early signs. The National Governors Association, all 50 governors are actually getting together tomorrow, and we expect by Thursday that they're going to make an announcement on this topic. We don't know exactly what it's going to say, but the early signs are it's going to be tremendous. I'm hoping to see all 50 governors united behind something about computer science, because this is an issue really that everybody can get behind.
You've shared your story with us here over the years, but I want to remind our viewers, you grew up in Iran, your school didn't offer computer science, but you were still able to get access to a computer, and it changed your life. If your school had offered computer science, do you think your life would have been different?
Well, for me, I had a father who was a physicist and a mother who was a computer scientist. So even growing up in post-revolutionary Iran during a war, I was learning to code on my own. But if you think about the most underprivileged kids in today's world, the kids who are getting left behind, what's the one thing we can teach them in school that gives them a pathway ahead? Or that even just gives them the confidence that I can build something, I can make something, I can change the world, I can be a creator. Kids want to create, and right now they're becoming creators on TikTok or Instagram because that's easy. If they knew that they could create apps and create software, there's a whole world of opportunity that we would open up for them as well.
There's also the how. What are schools getting right when they are trying to deliver this curriculum, and what are they getting wrong? I mean, I've got multiple children in school, and there's this thirst for more computer science, and I even wonder if they're doing it the right way.
Yeah, one of the challenges is to make sure computer science is taught creatively. So it's not just about learning these things and memorizing and passing the test, but more like, what do you want to create? What app do you want to create? What game? What website? To basically draw out the natural creativity. And when it's taught that way, it also brings in diversity into the field, because more students are interested in creating stuff than they are in just sort of doing rote work.
So how long do you think before we get to 100%?
I'm pretty confident that by the end of the decade we will, because there's now multiple states saying that it's going to be required for graduation. There's now 5 states that require computer science for graduation from high school, and when you do that, you get to 100%. You also fix the gender gap, you fix the racial equity gap. Every student learns computer science.
So this is the secret to everything.
Pretty much, yeah. I mean, in South Carolina, for example, it's the first state that required computer science for graduation. There's now more young women in South Carolina learning computer science than the 5 states surrounding it. Even though those 5 states have 10 times more young girls in school, South Carolina is beating the total of them combined.
That's amazing. How do you think the macroeconomic conditions going into a downturn will impact all of this? Are you at all concerned that other things will take priority?
I actually think this is the best time to invest in this, because actually many states have surpluses that they can spend on education. And also any location that's worrying about economic downturns can bring jobs to their region. In the past, if you wanted to attract high income jobs, you need to attract an office to be built. In the world of remote work, all somebody needs to do is educate people, and the jobs will come to the region. Whether it's a city or even a small town in a rural neighborhood can bring tech jobs, high-paying tech jobs.
All right. Well, it's been wonderful to see your progress over these 9 years, and we'll be watching for more. Code.org founder Hadi Partovi, thank you for joining us here in the studio.
Thank you.
That does it for this edition of Bloomberg Technology. We've got a big interview coming up tomorrow. The CEO of IBM, Arvind Krishna, will be with us. We're going to talk to him about everything from the downturn to the supply chain and more. You don't want to miss it. I'm Emily Chang in San Francisco. This is Bloomberg.